In a world of rising interest rates, what truly protects wealth? Is it gold, the asset that has survived thousands of years, or sovereign bonds, the so-called paper promises backed by governments? Because right now, something unusual is happening. Gold is rising, yields are rising, and that breaks one of the oldest rules in finance. So the real question is, which asset actually wins in high interest rate cycles? To understand this, we need to zoom out. When central banks raise interest rates to fight inflation, everything in the financial system starts to shift. Borrowing becomes expensive, liquidity tightens, and most importantly, yield becomes king. Now here's the key difference. Sovereign bonds pay you interest. Gold pays you nothing. No income, no yield, no cash flow. So in theory, gold should lose. But reality isn't that simple. Let's start with sovereign debt. When interest rates rise, new government bonds start offering higher yields. That means investors earn steady income, and that income compounds over time. This is powerful, because in high-rate environments, you're not just preserving wealth, you're growing it predictably. And here's why big institutions love this. Deep liquidity, low default risk, stable cash flow. This is why sovereign bonds often become the anchor of portfolios during tightening cycles. Now compare that to gold. Gold doesn't generate income, it just sits there. Its value depends on fear, inflation expectations, currency instability. And here's the problem. When rates go up, the opportunity cost of holding gold rises. Because instead of holding gold, you could be earning 4%, 5%, even higher, in bonds. So logically, gold should fall. But here's where things get interesting. In 2025 and now into 2026, gold is rising despite high interest rates. That's not normal. So what's driving it? Central banks are aggressively buying gold. Global debt levels are exploding, and investors are hedging against long-term currency risk. This creates a rare situation, where yield and fear are rising at the same time. So let's break it down clearly. Sovereign bonds generate income, benefit from high rates, provide stability and liquidity. Gold protects against systemic risk, hedged against inflation and currency debasement, but generates zero yield. So in pure high-rate environments, bonds usually win, but in uncertain, unstable systems, gold becomes insurance. And this is the key insight most people miss. It's not about choosing one. It's about understanding when each one dominates. High rates plus stability means bonds outperform. Crisis plus uncertainty means gold takes over. Smart capital doesn't pick sides. It adapts. So the next time rates rise, ask yourself, are you chasing yield or protecting wealth? Comment your pick, gold or bonds, and subscribe for more deep insights into global markets.